Welcome back. You're here for day 5 of our Market Mastery series. Today, we are going to talk about just one number, a number that I promise you can completely change how you see the stock market. Most investors totally ignore it, and you know what? That is a huge mistake.
Just think about that for a second. It's so true, right? Our gut reaction, our natural emotional response to the market, it's often the complete opposite of what we should be doing. We panic sell when we're scared, and we pile in and buy when we feel on top of the world. Today, we're going to learn how to flip that around.
So, why are our instincts so often wrong? Well, it's because we're reacting to the noise, the scary headlines, the chatter, the panic. We're not reading the real underlying mood of the market. But what if I told you there's a way to measure that mood directly? And this is it. This is the signal in all that noise. A simple 2-digit number that acts as the market's official fear gauge. And checking it, well, that takes less than 2 seconds.
Now, this connects right back to what we've already learned. Remember on day 3, we talked about bull and bear markets? That tells you the market's direction. Is it going up or down? Well, the India VIX tells you about the intensity of that move. Think of it like a volume knob. Is the market's mood a quiet whisper, or is it a deafening roar? The VIX tells you exactly that. So when we talk about intensity, or the market's mood, what do we actually mean by that? Let's break down the core idea here, which is something called volatility. Volatility sounds like a complicated word, but it's really not. It's just a way of asking how much are prices swinging around. On a calm, low volatility day, the Nifty might just move, 50 or 80 points. It's kind of boring, pretty predictable. But on a wild, high volatility day, that's when you see those huge 300, 400, even 500-point swings that make all the headlines. And this right here is a really key point. A lot of people get this wrong. High volatility does not automatically mean the market is crashing. You can have wild swings going up, wild swings going down, or just a ton of choppy action that ends up going nowhere. It's all about the size of the moves, not the direction. So what is the India VIX? It's the volatility index, and the most important word on this slide is expects. This isn't about what happened yesterday. It's a forward-looking number. It's basically the market's collective bet on how wild or how calm the next 30 days are going to be. The simplest way to think about it is this. When people are scared about the future, what do? They buy protection, like insurance. In the stock market, that protection comes in the form of options. When demand for that protection goes up, so does its price. That price is the VIX. So when fear is high, the price of fear is high. Okay, so if the VIX is a number that measures fear, we need to know how to actually read it. Let's decode what the different levels really mean. What's the difference between the market being a little nervous and being in a full-blown panic? Here's a really simple guide. If the VIX is below 12, things are extremely calm, maybe a little too calm, even complacent. Between 12 and 16, that's your normal everyday zone. But once we start creeping above 16 and getting close to 20, the market's getting nervous. There's a bit of caution in the air. Above 20, you're officially in high fear territory. You should expect some big moves. And once you cross 25, well, that's panic mode. But notice that last bit. Panic for most people can be a huge opportunity for the brave. All right, now we get to the single most important and honestly, the most counterintuitive idea from today. This is going to challenge a belief that most of us have about market risk. Let that sink in for just a moment. The real danger isn't when everyone is panicking and the VIX is up at 28. The real risk is when the VIX is at 11, the skies are clear, and everyone feels like a genius. That's when complacency kicks in, and that's when the next big drop is quietly setting up. So the million-dollar question is, how do we use this completely backwards insight to make better decisions? How does this actually apply to you and your money? Well, it depends on your strategy. If you're a systematic investor just doing your monthly SIP, honestly, you can pretty much ignore the VIX. The whole beauty of a SIP is that you invest automatically through all conditions, good and bad. But if you're looking to invest a lump sum, then the VIX becomes absolutely critical. It's your guide for when to be cautious and when to be courageous. Here's the simple playbook. When the VIX is high, let's say over 22, it means the market is scared. Fear makes people sell, and that means prices often get cheaper. This is a potential buying opportunity for long-term investors. And the opposite is also true. When the VIX is low, say below 14, everyone is calm and comfortable. Prices are often at full value. This is a time for caution, not for going all in. And if this whole idea still feels a little strange, just remember this. Warren Buffett's most famous piece of advice is just a simpler way of saying, buy when the VIX is high.
It is the exact same principle. Use widespread fear as your entry signal and use widespread comfort as your signal to be careful.
Okay, let's wrap this up with one simple, actionable habit you can start building today, something that will pay off for years to come in your understanding of the market.
It's this simple. Every morning, before you look at anything else, just Google India VIX. Step 2, just look at the number. Is it a 14, a normal day, or is it a 25, a day of panic? And then step 3, just ask yourself that one question.
If you do this consistently, you'll stop reacting emotionally to the headlines. I guarantee it. The next time the market drops 3%, instead of panicking, you'll check the VIX. And if it's high, you'll realize this is expected behavior, not some crazy chaos. You'll start to build a real instinct, and it all begins with this one number.
So, I'll leave you with a question. As soon as this is over, I want you to go and check what is the India VIX right now. And based on that number, what's the market's true mood today? Answering that question is your first real step toward mastering the market.